It is IPO season. So in the last 12 months, we've seen Airbnb, Coinbase, Bumble, Roblox, Palantir, Snowflake, DoorDash, all go public, and that's just to name a few. And coming up soon, we've got the IPOs of Discord, Stripe, Robinhood, and the most delicious of them all, Krispy Kreme. But should you be buying any of them? This is the reason why you shouldn't buy any IPO stock as soon as it becomes available. An initial public offering is where a company makes its shares available for the public, you and me, to buy for the first time on the stock market. Before a company goes public, it's private, and the only way that you can invest in a private company is if you're involved in the company in some way, like you're an employee or a founder, or if you know someone at the company who will let you invest in it. You won't find a private company on a stock trading app, like the ones that are linked down below in the description, where you can get a free stock worth all the way up to a lot of money if you sign up using one of those links. To know why an IPOing company's stock price might drop after its opening day on the stock market, you need to know why a company might IPO in the first place. The main reason is to raise money for the company. Companies need money to do company stuff.
The plan was to hire 15 coders, and where exactly would we put them?
Easy. Right around here.
And a company could get more money in the same way that it had got investment up to that point by selling more shares to private investors.
Do we have a deal?
No, is it going to be a deal?
But if the company's big enough, it can kill two birds with one stone by doing an IPO. An IPO is good for a company because it's also an opportunity for existing shareholders to sell their shares to realize their gains. What gains? When a company's big enough for an IPO, the shareholders who bought in early will have a big chunk of money tied up in the company. The shares that they bought when they invested years ago will be worth a lot of money, possibly billions of dollars. But that's paper money, it's illiquid, you can't spend it. To turn that paper wealth into cash, the shareholders need to sell their shares to new investors. And an IPO is the way to do that. Now here's where the problems with IPOs start. Because an IPO is an opportunity for shareholders to cash out of their investment, it's in those shareholders' interest to hype up the company so that its perceived valuation is as high as possible. When a company decides it wants to go public, the way it usually happens is they go to an investment bank like Goldman Sachs or JP Morgan.
You want to bet against the housing market?
And an investment bank agrees to help the company sell the shares that it wants to sell in an IPO. Many companies want the help of an investment bank to introduce them to the investment bank's wealthy contacts, like high net worth customers of the bank, as well as hedge funds, pension funds, and just other big time investors. The investment bank isn't doing all this for nothing. Before the investment bank introduces the company to those investors, the investment bank offers the company a guaranteed fixed price at which it'll try to sell the company's shares. So it's in the bank's interest to build up hype around the company so that the investors are willing to pay more per share. So the bank arranges a tour with the company to physically go round and meet all of its big investors just to build up hype.
Object to the test!
After the tour, the bank says to the investors, right, come and buy your shares. And the bank sells the company's shares to the investors at the highest price that the investors are willing to pay.
$1.
I have a buck. I have $1 there, $1 there.
After that, on the IPO's opening day, which is where retail investors like you and me can buy the stock, the big investors who bought shares of the company can either hold on to their shares or they can sell them to us. So when we buy shares of an IPOing company on its opening day, we're probably paying a highly inflated price. First, the company will have probably decided to IPO when it's doing very well financially and probably an all-time high valuation. Then an investment bank, seeing that all-time high valuation, thinks, you know what, we want to make some even more money on top of that. So it guarantees its fixed price per share to the company, and it tries to get even more from investors by hyping up the company. Those investors have bought at that hyped up valuation, and they're thinking, you know what, I don't want to hold these shares, I want to flip them on the IPO opening day. So those big investors then have to hype up the company even more so that the perceived value of the stock by you and me, retail investors, is even higher. And then, my goodness, if the price goes up on the opening day and in the following weeks and months, you just know that that's going to be a massively inflated valuation. Once everyone's calmed down and it's been a few months since the IPO open day, the stock price usually drops down to a more sensible level once the company has released financial reports that don't quite live up to the massive expectations. Some of the biggest IPOs in history were Visa, General Motors, Facebook, Alibaba, and Uber. All their prices within a year dropped down below the opening price. A year after IPOing, Visa had dropped 13% below its opening day price. And that number was 35% below for General Motors, 32% below for Facebook, 30% below for Alibaba, and 30% below as well for Uber. And these aren't just some cherry-picked examples. A historical study performed by the Financial Times found that the average IPO drops 31% below its opening day price within 3 years, looking at the almost 4,000 IPOs since the 1980s. So as a retail investor, if you buy any IPO stock on its opening day, you should expect to lose about 30% of the money that you put in if you sell it within the first 3 years. That's why you should always buy stocks with the intention for holding them long term. If I do really believe in an IPOing company and I want to buy it to hold it long term, I'll wait at least 6 months after the IPO opening day to buy it. There's always a chance that if you don't buy an IPO stock on its opening day, that it will just keep going up and up and it will never go down below that opening day price. But more often than not, it will. Like and subscribe to see more videos about becoming rich in every sense of the word. Hit the notification bell and don't forget to get your free stocks down below in the description. Thanks for watching. This is Debt to Millionaire.